We had a pretty quiet final day of the month of August with the S&P 500 down just 0.15%, but we had some interesting things taking place nonetheless. Of note, most of the Magnificent Seven still managed to close green today, whereas the rest of the stock market, about 2/3 of the market, was down, so they really helped us along. We had a really big pullback in some of the healthcare names, especially the managed care names. That did put a little bit of pressure inside some of the other indices and sector ETFs that were out there. In tonight's video, because it is the final day of the month, we're going to take a look at the heat map from a monthly perspective and see what's been going on all around the globe. We're going to find out that China and Brazil have not been great places to be hanging out here lately, in the stock market at least, but there's been some other areas like Japan and France that have held up a little bit better from that regard. We'll also take a look at what's been going on from a macro perspective. Bitcoin gave a big chunk of their recent gains back here today. We also saw that treasury bonds continued to rally, but they're at a resistance point, so we'll see where that brings us next week. And then at the end of tonight's video, as always, I've got a trade application example, and in tonight's video I'm actually going to be selling short one of my favorite consumer discretionary dividend stocks, but it does look like it's going to be a little bit bearish in the short term. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 31st, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. We'll also let you know which stocks are giving you overbought and oversold cluster signals within the S&P 500 at the bottom of those emails. In addition to that, we're heavy users of X, formerly known as Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZ, and we really appreciate those of you that click like and repost on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into it. Now, as you can see, I've got a heat map pulled up here in front of us, which is often the case when I'm doing these videos, but you'll notice that it looks a little different than it typically does. This particular heat map is, first of all, it's a 1-month performance, so with today being the final day of August, I thought it would be useful for us to kind of take a bird's eye view and witness what had just happened in the previous month, as this has been a slightly different month than what we had been used to for much of 2023, largely in the way of a bit more selling than normal. Luckily, we had a fairly decent rally here over the past week, but that did not offset the selling that took place earlier in the month of August. And so what we're looking at here are a bunch of different ETFs and what their performance was over the last month. Now, one thing that catches my eye when I first pull this up is I assumed we would be looking at a lot of red, but somewhat interestingly, bonds actually closed higher for the most part in the month of August. Right? I don't know if that's necessarily what we would have assumed. I think a lot of us feel like we're still in a rising interest rate environment, and typically bond prices are down when that is the case. But we've had a pretty healthy pullback in rates here in just the last week or so, and I think that kind of got these bond funds to the finish line here just at the end of August. But you'll notice that most of these ticker symbols off to the right-hand side here, that's in your fixed income category. You've got your U.S. government bonds, you've got your corporate bonds, your broad market bonds, and even some of your foreign bonds down below. The foreign ones were a bit more hit and miss. You had a bit more selling in those ones, but most of them in the United States were positive on the month of August. And that even includes some of the more popular ones out there, like the junk bonds that we talk about on occasion. They were up 1.22%. And remember, that's not necessarily something that we would assume in a month where the stock market is down. Oftentimes the junk bonds are the ones that will kind of have a little bit more risk appetite associated with them. But having said that, you guys also know that I've mentioned many times throughout the years that the junk bond market does have a little bit of a correlation to the energy markets and oil prices in particular. And you'll notice here in the upper right-hand corner, we've got our commodity ETFs. And notice how we have a number of green shaded rectangles and squares up there, including crude oil itself up about 5% this month. Natural gas was up about 6% this month. We had some of the metals like silver was up this month as well, about 3%. Gold managed to eke out a gain. We've been talking about that one a little bit more with our 12 grid analysis and talking about how they had really had a sell-off here up until a couple of weeks ago and had all those oversold cluster signals, and now have had a pretty solid reversion to the mean move since then. So they barely managed to close in the green for the month of August. But because oil was up and natural gas was up, I think that gave the junk bonds a little bit of an opportunity to have a little bit of upside there despite the stock market struggling. Speaking of which, let's take a look at all of these squares and rectangles towards the left-hand side now, and you can see most of those are in the red. And you can see that the foreign markets really struggled. So here's your international markets. Of course, we talk about EFA quite often when we're doing our 12 grid analysis. It was down about 1% over the past month. EEM we also talk about. That's the emerging markets. They were down about 3% over the last month. One country in particular that really stands out to the downside is Brazil. They've really been getting hit. They were down about 6% this month. China was down about 5% this month. So that doesn't really help all that much, right? Those are two important countries there. We did see that Japan managed to eke out a gain over the past month. So, there were a handful of places that didn't have as much damage, but for the most part, you look in that international category there, you got a lot of red. It's even worse than what we saw with most of the S&P 500. So S&P 500 was pretty much flat on the month, but the Dow was down about 1.4%. The equal weighted S&P 500, by the way, was down 2%. And so there is a big divergence there between the market cap weighting and the equal weighting. And I think we all know the reason behind that. It's the story of the year, Magnificent Seven, NVIDIA, Amazon and Google and Tesla and all those types of companies are really outperforming the typical stock that's out there right now. So tough month for the average stock in the S&P 500, but a better month for the portfolios that have a heavier weighting towards the biggest market caps. You'll notice that when we look at the U.S. sectors down below here, we have much more red than green there as well. Utilities have been just getting hammered here. We talked about that quite a bit in my question and answer session today. We are talking about some of the most extreme underperformance of the utilities versus the S&P 500 that we've seen really in the last couple of decades. So they're really getting hit hard. They were down about 5% just this month alone. Remember, utilities usually don't move all that much. But they were the worst performing sector from what my eye can see right here in front of us. So typically you're going to have the utilities kind of hugging the middle line a little bit more. They're not going to be an outlier to the upside or the downside, but right now they are definitely an outlier to the downside. Consumer staples also struggling right now, as is real estate. So some of those key interest rate sensitive areas are the ones getting hit the hardest at the moment. In terms of areas that are trying to do a bit better, you can see that energy, of course, held up like a champ. You can see here that the XLE, which is the main energy ETF, was up about 3.5%. XOP is not a sector ETF, it's more of a industry ETF. Nonetheless, it does track energy prices pretty nicely, and it was up 6%. So those were probably the areas that caught a little bit of a bid during the month. By the way, the financial sector itself, XLF, was down 1.86%, so that wasn't the end of the world, but I should point out that one area within the financials, an industry that's important, the especially regional banks here, KRE was down 7%. So again, it's not damaging the overall XLF as much as you might think, but if you have more exposure to the regional banks, you probably suffered a bit more in the month of August there as well. So those are kind of some of the main hits and misses there. I guess to summarize, bonds were up, stocks were down, international stocks were down, and if you were looking for a little bit of good vibrations within the stock market, it probably helped if you were hanging out in the energy or perhaps other commodity areas like the metals. Let's also take a look while we've got the 1 month performance pulled up at the world view. Now this is not the best of views because this is really kind of where they've listed their corporate home address, but it's not really always the home country that they truly reside in. So as an example, you see Pinduoduo here listed in Ireland, and of course most of us are aware that is a Chinese company. You also see Medtronic listed there in Ireland, and of course it's a good old company here in Minnesota of the United States of America. But it is true that many companies did a bit of a tax haven there a few years back, and on paper it may look like they are headquartered there, even though they have very little in the way of actual infrastructure on ground there in that particular country. So this is not the perfect way to look at this, but it will still give us kind of an interesting view, a lay of the land, and pick up maybe a few pointers here and there with the 1 month view here on the world chart. And China of course remains extremely important outside of the United States, and you can see here in China we had a tough month, right? Vast majority of these stocks listed here are in the red, including the biggest one there with Alibaba down about 2%, but JD.com was down 13% this past month, so that was a tougher one, and you can see the rest of them there mostly in the red in China. We also saw Brazil struggling, as I had mentioned before. Here's Brazil kind of in the lower left-hand corner. You did have Petrobras up because of its association with oil prices, but for the most part, the other Brazilian stocks really struggled here last month. I do see that SBS, which is a water utility company in Brazil, managed to close in the green, but most of the other names that you would recognize, especially the financial names there in Brazil, really taking it across the chin here at the moment. So China, Brazil definitely out of favor here at the moment. We did have a little semblance of strength in Japan. So Sony was the outlier there. They were down about 8%, but otherwise, especially the financials in Japan actually held up quite nicely. So quite the extreme difference between the financials in Japan and the financials in Brazil. But those Japanese banks holding up reasonably well here at the moment. United Kingdom was about split, kind of 50-50 there, depending upon what area of the market you were looking at. You had those big oil companies like Shell and BP, of course, holding up okay in that regard. France actually had a good month, it appears. More stocks up than down in France, and you could probably say the same thing about Spain. Of course, there's not as many opportunities in those areas, at least for U.S. investors. We don't have a whole lot of ADRs that track the individual stocks in those countries. Nonetheless, the ones that do did manage to close mostly in the green in that regard. So anyway, I think the story there in this view is China, Brazil really struggling here at the moment. Japan is an important market, and it managed to hold up reasonably well. Let's now take a look at the S&P 500 here in the United States over the past month. And here you can probably see why the information that I gave you a little bit ago is true, which is the RSP, which is the equal weighted S&P 500, actually was down on the month. So in other words, the average stock in the S&P 500 likely has a red square here. But the market cap weighted S&P 500 was actually flat. And so the reason behind that is most of the bigger squares here actually did manage to close in the green. The exception to that is Apple. Apple was down about 2.5%. Otherwise, it was actually a decent month for the Magnificent Seven. I don't know if that's really the sentiment or the temperature out there right now, but it is the truth. The truth is staring us right here in the face. Right? We've got Microsoft up by a skosh, not by much, but still in the green for the month. NVIDIA was one of the big winners, right? They were up 11% on the month. Google had a very good month, Alphabet, up 7% there. We did see that Meta close lower as well, so they kind of sat it out alongside of Apple. They were down about 6% on the month. But we had Tesla that was up 1.5%, and we had Amazon that was up 7%. Remember, I did a bullish trade example on Amazon in the market outlook video that I did for you guys on Tuesday, and I noticed that stock was one of the better bounce candidates out of today's trade. So it really stood out to me, and looks like we're heading in the right direction with that trade so far. Obviously, we're early on in it, but I did like to see that bounce out of Amazon here today. But they had a good month in general. They were up 7% for the full month of August there. So those are your big important tech related players that are out there. But even beyond that, some of the bigger squares that stand out, you can see Eli Lilly had a great month. It was up nearly 22% in a single month. Remember, that is now the most valuable healthcare company in the United States, and it was up 22% in a single month. Amgen had a great month as well, up 11%. You see down below here, Exxon and Chevron both managed to close in the green, with Exxon doing quite a bit better, up about 5 or 6% there. And then Berkshire Hathaway also had a nice month, up 2.5%. Of course, a big happy birthday there to Warren Buffett yesterday as he turned 93. For those of you that follow me on X/Twitter, you'll know that my timeline was most definitely dedicated to him yesterday. So if you're interested in that, make sure you check it out. But yes, he did celebrate his 93rd birthday. Remember, Charlie turns 100 on January 1st. So that'll be another big celebration here, hopefully in about 6 months, assuming there's no bad health situation or anything like that. But in addition to Berkshire Hathaway doing well, a couple of other giants in the financial space, MasterCard and Visa, also had very strong months. I brought those two up. We didn't look at the charts on Tuesday, but I brought them up verbally to you, telling you that their charts were firming up really nicely, and now I see why. They had really strong months in the here in the month of August. So again, it's kind of interesting that the vast majority of small stocks have red squares, but the vast majority of big rephrase that. The vast majority of smaller squares are red, meaning that the smaller market cap companies closed lower on the month. But the majority of the bigger squares, or the bigger market cap companies, actually are in the green, telling us that they were up on the month. So quite the interesting division between those two areas in this month of August, and that explains why we saw the difference in the equal weighting S&P 500 versus the market cap weighting S&P 500. All right, so that's your 1 month view. Let's now kind of zoom in to our traditional 1 day view here in the S&P 500 and see what happened today. So there's one square that really stands out to my eye, and I've already mentioned it, but it's staring us right in the face, right in the middle of our screen there, and that is Amazon. Nice to see it up 2% on a day when the stock market was actually down, when we just placed a bullish trade on it 2 days ago. So hopefully that those good vibes continue for that particular reason. But we also had some strong performance out of Google and Tesla and Meta, and also NVIDIA. All of those, and also I could throw Apple in there just barely, but you'll notice that out of our Magnificent Seven, we only had one that was in the red, and that was Microsoft, and it was only in the red by the tiniest of bits, right? Not even 0.5%. So it was another good day for the Magnificent Seven, another pretty much bad day for the rest of the market, right? You look at all those red squares. I'm sure that when we look at the statistics here in a moment, we're going to find that there were way more stocks down than up today, yet 6 out of the 7 most important companies in this market right now were higher here today. It seems to be a theme in 2023. Other major stocks that were up nicely today, Adobe continues its run. We've been talking about that one a bit more in my top-down trend trading class lately. Broadcom had a strong day in the normal session. However, it did report earnings after hours, and it is getting hit after hours. So expect that one to be down tomorrow morning and giving back today's gains. We also saw that Walmart was up nicely today, as was Costco, which is kind of interesting because some of the worst performing stocks in the market today were the discount retailers, especially Dollar Tree just got hammered there, down 12% today, one of its worst days in quite some time. So it's impressive to see Costco and Walmart up on a day like that. We also saw that Eli Lilly, of course, with their weight loss drug, up another 1% today, while most of the other healthcare area was down. We talked a lot about healthcare in my question and answer session today as well, as a result of the news that we heard there a couple of days ago with the Medicare Part D drug price negotiations taking place. You did see that the energy stocks were largely in the green today, so that was another place you could have been hiding out and been able to avoid some of the disaster. But for the most part, you look at those smaller sectors off to the right-hand side, and they were largely in the red. Most of the healthcare, most of the consumer staples, most of the industrials, most of the real estate, most of the utilities, in fact, maybe all of the utilities. As far as I can tell, all of the electric utilities were down today in the S&P 500. There might have been a couple over here in some of these other categories, like NiSource was up just barely in the regulated gas utilities area, but all the electric utilities, minus sign in front of them. Most of the basic materials also in the red there. Most of the consumer discretionary stocks were in the red as well. Most of the financials were in the red. So really today, if you were looking for any green to avoid the selling, you probably were either in the energy area, the technology area, or maybe a smattering of the mega cap communications and consumer-oriented areas, with Amazon doing particularly well. One of the brighter red squares from a negative perspective today that really stands out is United Healthcare. A lot of those, managed care and health insurance-related companies struggling here today. All right, let's go ahead and take a look at the official numbers now and see what our breadth looks like here in the S&P 500 on this final day of August. You can see here we had 174 out of the 500 stocks in the S&P 500 close higher today. So that's good for about 35%. So we had approximately a third of the stocks up and 2/3 of the stocks down. Yet a lot of the Magnificent Seven were amongst those minority 1/3 that managed to close in the green. And so that made the S&P 500 perhaps look a little bit better than it deserves to if you're looking at it on a market cap weighted basis, which is what most people do. So let's take a look at those charts now. And you can see I've got chart 4B pulled up here in front of us, so that way we can look at the foregrid within the United States. And the chart in the upper left, of course, is the S&P 500. This is the market cap weighted one, so the traditional one. And it did close lower today by 0.16%, but you'll compare that to something like the Dow Jones Industrial Average. It was down 0.5% today. And you look at those two charts, and the S&P 500 does look better than the Dow here at the moment. There's a couple reasons for that. First of all, notice that the S&P 500 is still above its 30-day moving average despite the small sell-off here today. In addition to that, notice that the background color of the chart went to that brighter green color, which means that we now have a strongly bullish posture on the S&P 500 as this green intermediate line has just barely crossed above the 50th percentile. Remember, that could be easily back below the 50th percentile tomorrow. So, it just depends on whether we get an up day or a down day tomorrow. So, but it's a little precarious here. So we just want to make sure that I'm giving it to you straight, so to speak, in that regard. I don't want to make it seem like, hey, it's all roses and we're off to the races again. This could reverse fairly quickly. And remember, the month of September is oftentimes a little bit more of a queasy one for investors. So we have to make sure that we're open-minded as we head into what is oftentimes viewed as the roughest month for stocks here in the month of September. But for right now, it looks reasonably good. Like, do we want to see a red candle today? No. We would always rather see, the bullish candles. But was this a disaster type of a day? No. I mean, we just had 4 straight days to the upside. You got to figure you're going to give some of that back. And if all we're going to do is give back 0.16% when the bears finally take control, that's more of a whimper. So it doesn't mean that things can't accelerate tomorrow or next week or what have you. But for right now, I think we'll take it. If we finally got a sell-off day after 5 days, and that sell-off day was a whopping 0.16% move lower, I would say that we fared pretty well in that regard. Now, comparing that to the Dow Jones, things here look a little bit more concerning to me. Now, it's not a disaster by any means, but without a doubt, the chart looks a little bit more challenging than what we saw with the S&P 500. As I mentioned before, the Dow Jones was down about 0.5% today, so it was the worst performer. Remember, the United Healthcare is part of the Dow Jones Industrial Average. It's one of the 30 stocks there, and as one of the higher price stocks within the Dow, it has a bigger influence on that price-weighted index. So part of the story here is probably United Healthcare. Whatever the reason, the chart doesn't look all that accommodating, because you'll notice here that while we still are retaining the weekly bullish posture, note that the green line is rising, but it has not yet crossed above the 50th percentile the way that it did over here with the S&P 500. So it remains with that weekly bullish posture at the moment. That's not as concerning to me as just the eyeballing the shape of the chart. I don't really like the look of the Dow basically stalling out at the highs of the day, the last 2 days, right at that falling 30-day moving average, and then having that moving average reject the price action back lower. It's not a good look, right? You want to see it slice through it like a hot knife through butter type of a situation if you're expecting bullishness. So right now there's hesitation. It got back up there. We're happy to see that, right? You nearly had a cluster down here, didn't quite get it, but you were very close to it here a week ago. When we started this run, we got our reversion to the mean move here, and it had a pretty decent move in those 4 days as well, just like the S&P 500. But the fact that it's stalling out underneath that falling 30-day moving average does make it different than the S&P 500 that managed to get up and over it. And remember, the big difference between those two is there's a lot more tech exposure and Magnificent 7 exposure in the S&P 500 than there is in the Dow. Remember, a stock like Nvidia, a stock like Tesla, a stock like Amazon, they are not in the Dow Jones Industrial Average. So while we've seen that big push out of those mega cap tech stars once again in August on a comparative basis, it's helping some of these indices, but it's not helping others. And right now the Dow is kind of, sitting it out from that particular perspective. Now the Dow does have, maybe an edge on something like the NASDAQ in the Department of Oil, because you do have Chevron in the Dow. So there's, different ways that you can kind of evaluate this stuff, and some pros and some cons out there. But right now, I think that is a limiting feature of the Dow, the lack of Magnificent 7 exposure there on a comparative basis. Remember, we do still have some Magnificent 7 exposure in the Dow with stocks like Apple and Microsoft, but it just doesn't have all of them the way that the S&P 500 will and the NASDAQ Composite will. So the Dow is the one that probably looks the most concerning here at the moment, and one that we're going to have to keep our eye on, tomorrow and as we head into next week. On the two bottom charts now, the NASDAQ Composite was up today. Yes, you heard that correctly. It was up. The other three indices were down, but the NASDAQ managed to actually still close in the green today as a result of that push into the Magnificent 7 and other tech-related names there. So NASDAQ was up, not by much, but by 0.11%. And like the S&P 500, you'll notice that the background color of the NASDAQ Composite is now strongly bullish as well, with that brighter green shading right there. Obviously, price is above the falling moving average at this point, so both of those are falling, so that's why it's yellow as opposed to a green moving average. But the longer we stay above the moving average, the greater the chance is that the moving average will then start getting bended higher, right? It's a lagging indicator, but right now part of that 30-day moving average is incorporating the sell-off that we had here, so that's why that lagging indicator is pointing a little bit lower at the moment. But I don't really think it would require much to pull that moving average line up. It could easily be to a green moving average, early next week, assuming we don't have any major sell-off days. So let's keep our eye on that possibility. But it's part of that leadership group. You could probably say the NASDAQ is even more of a leader than the S&P 500 because the intermediate line is at 55, whereas on the S&P 500 it's at 50. So NASDAQ probably the leader of the market right now due to the market's extreme interest in mega cap tech here at the moment. Remember that Apple does have an investor day coming up on September 12th, I believe. So that could play a role and have an impact on the Magnificent 7 as we get a little bit closer to that date as well. Off onto the right-hand side in the lower area, we'll then take a look at the Russell 2000. It's been a tough month for the Russell 2000, but it's been a pretty strong week for it. So, we did finish a little bit lower today, but it wasn't bad. It wasn't as bad as the mega caps on the Dow. It was only down 0.19%. But similar to the Dow, it is a little bit more concerning than the S&P 500 and the NASDAQ because you had your reversion to the mean move. The moving average itself is going lower like it was with the Dow, and it has yet to, breach that moving average. With the Dow, at least you touched it a couple of times on the highs of the intraday basis. With the Russell 2000, we haven't even touched the 30-day moving average here. So that just goes to show you how aggressive that sell-off was here in the past month, a lot of it being led lower by those regional banks that I had mentioned when we were looking at the 1-month heat map. Looking at something like KRE down 7%, that's going to have some damaging impact there on the Russell 2000 that it's not going to have on the S&P 500, the NASDAQ, and the Dow, which are all mega cap or large cap related names. So are there going to be some regional banks there? Yes, but it's going to have a more direct impact on the Russell 2000, which has about 10% of the index in the banks specifically, not just the financials broadly, but the banks specifically from an industry perspective. So they're doing what they can to recover there, but it's a little bit more challenging when you've done as much damage as has been done there on the Russell 2000. Nonetheless, it does remain with a weekly bullish posture. So all 4 of our charts do continue to have bullish postures. The Dow and the Russell are weekly bullish. The S&P 500 and the NASDAQ are strongly bullish. And then when it comes to the moving averages, the Dow and the Russell 2000 are the laggards, where price is still below a falling 30-day moving average. On the other hand, the S&P 500 and the NASDAQ are now back above their falling 30-day moving averages, and there's a decent chance that they can bend those moving averages higher as soon as next week. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. Remember, they do soak up a tremendous amount of time for both David and I. At least 3 hours of our day is dedicated to doing this video for free on YouTube. And so we always have to ask ourselves as business owners whether it's worth our efforts or not. Those of you that were in my question and answer session today might have heard that my sleep last night was not the best. According to my Apple Watch, I only got 3 hours and 45 minutes. So I don't particularly feel like soaking 3 hours of my day into this free video. And we, of course, make sacrifices almost every single day that we choose to do this video, including missing things like my son's Taekwondo event on Tuesday. I had to miss that as just one random example there. But, obviously, if we didn't want to do it, we wouldn't. But it is just a friendly reminder that we do make personal sacrifices for you guys in order to do a video that is completely free for you all to watch. So if you appreciate those efforts, we ask one simple request. And for most of you, that will not be a difficult request. It is simply to click like for us there on Twitter. And as long as we're up and over 100 likes, I'm more than happy to do a full-length hour-long video for you. Remember, in the old days, I used to only do a half-hour video. So I wanted to reward those of you that go out of your way to take the 5 seconds and support us by doubling the video length. So you guys got there this time around. I'm very happy about that. Thank you for the 115 people that do support David and I in these efforts. You're basically telling us that you want us to continue these videos. So if that's something that you want to participate in, it's very easy. It just takes 5 seconds out of your day to click a button, and you can trade that in for 3 hours of our day. I think you get a pretty good deal when it's all said and done in that regard. Then again, some of you will disagree with me on that point as well. So to each their own. But thank you to the 115 of you that did support us the last time around. Let's do some shout outs here. Thank you to Violina, thank you to Oana, thank you to George and to Brandon and to Fred and to Dennis and to Teddy and to ELS Coaching. I see you're a Patty Master Instructor. I know you know David, but it's funny when I see PADI because that's a different one that I'm used to. I'm used to the projected annual dividend income, and this one I think is more on the scuba diving side of the equation. But thank you for clicking like. I appreciate that. Thank you to Brian and to John and to Janet and to Eugene and to Pam and to Ann and Joji and Ken and Das and Christian and Duncan and Retro and Paul and Kirk and Floyd and Leo and Ed and Claire and Brad and Dave and Eddie, Paul, Margie, Ron, T-Fib, Jim, William, H. Patel, Business News, Trunk, Doug, Craig, Kenneth, Robert. Can't get to all of you, but my hope is that every so often you hear your name as a shout out, just to let you know that I appreciate you, and I hope you can keep that up. It means a lot to both David and I. Remember that we need to get the word out about our business, and we can also be monetized on Twitter now as well, thanks to some of the changes that Elon Musk has made here in the past year. So that helps a little bit. That's not the driving reason that we do it, but hey, every little bit helps in that regard as well. So thank you for those of you that make a commitment to us. It means a lot. Let's take a look here now at a couple of other things that are going on at Market Scholars today. Of course, I taught my question and answer session. And so if you are a premium member of Market Scholars, you're invited to participate in those sessions. I usually hold mine on Thursday morning, and David's is usually on Saturday morning. I think with this weekend being a holiday weekend, he'll take it off. But nonetheless, it's an opportunity for our premium members to work directly with David and I and ask us questions about their trade setups and different things like that. So today we had a good question about extra space storage and what's been going on with some of the REITs and some of the mergers taking place in that particular area, and how to read the dividend stair-step chart as a result of some of that craziness that is resulting of that because of the way that they had to chop up the dividend in a few different pieces. So some of that stuff gets a little confusing. This gives us an opportunity to explain that a little bit better. Also got a question about the 10 prescription drugs that are going to be subject to price negotiations, and what are my thoughts on some of those companies that are involved. I also got a question about VF Corp, of course, a company that cut its dividend several months ago at this point. And then I also got a question about EVRG, which is a utility stock. I got a question about Berkshire Hathaway, again yesterday, Buffett's birthday, talking a lot about Berkshire here lately, and how it has $1 trillion worth of assets, which is more than Microsoft, Google, and Amazon combined. So explaining what that means, because obviously that doesn't mean the same thing from a stock perspective, but from an assets perspective, that is true. And then also got a question here about Northwest Natural, which is a natural gas utility up in Oregon. So if you're interested in any of that commentary, feel free to check out the recording. It is posted to our calendar here at the moment, and you're welcome to check that out if you are a premium member of Market Scholars. Let's also have a chat here about the factor selector tool. Remember, this gets put together here on Tuesday evenings in anticipation of our Wednesday morning swing trading class. So it is a couple of days stale by this moment here on a Thursday afternoon. Nonetheless, it can give us a good lay of the land as far as what may or may not be happening from a factor perspective. Quality does remain on top for the second straight week. Remember, quality has a pretty strong correlation to the technology sector here at the moment, with stocks like Microsoft and Apple having very high credit ratings. They're going to be part of those quality ETFs in many of the cases. Momentum continues to click. Remember, momentum is effectively the same thing as trend trading. And so that's what I teach in my my Monday morning class to my premium members, is top-down trend trading. So we're happy to see that momentum is starting to click pretty nicely here. Of course, I teach dividend growth investing on Tuesday mornings, so we're happy to see that dividend yield manage to get itself up into that third place position. And then in the lower half of the rankings, we had low volatility, low size, and value. And my hunch as to why we had low size and value down there at the bottom is what we just recognized here a moment ago, which is that the regional banks have really struggled here in the month of August, and there's a bigger allocation towards those types of companies in these two factors, and I think that's kind of their bugaboo at the moment. So we'll see if they can shake off the rust as we head into September, but that's where things stand here at the moment. All right, let's get back on track with some of the traditional Thinkorswim charts here now. And I'm going to take a look first off at chart 5A. And this will be our asset class 12 grid. And this is a way for us to get a lay of the land from the market forecast perspective. Remember, when you're looking at these 12 grid charts, the background color will tell you whether the posture is bullish or bearish, with green being bullish and pink being bearish. So let's get started in the lower two corners, as we often do. And start in the lower right-hand corner here. This is the 10-year U.S. Treasury yield, and it does continue to have a weekly bearish posture. Remember, that was already the case when I was with you on Tuesday. It continues to be the case today because we've had another pullback in rates. And this is kind of what I was mentioning before, how it was a little surprising to look at the full heat map for the full month of August and see that bonds were actually up in the month of August. I don't think that's the impression, generally speaking. If you just, randomly asked 10 traders out there, were bonds up or down in the month of August, I'm going to guess that most of them would have told you they were down, but that wasn't true. And it's largely because since the Jackson Hole event, we've had a little bit of a relief rally in bonds and a pullback in rates. And, while that's good on the surface, or at least I consider it good because I like to see interest rates lower, not higher, if at all possible. It makes my job of managing within the stock market a little bit easier. So don't get me wrong, I'm happy to see it, but I would caution getting too excited about it. And the reason I say that is this is still a good looking chart here on the 10-year U.S. Treasury yield. Yes, it has a pink background color, and we have to respect that and, stay open-minded to a potential breakdown. But as you can see, all that's really happened with this chart is we have just offset the tremendous bullishness that happened from this moment to this moment. Yes, this has been a pretty aggressive pullback, but it's only because this was a really aggressive move higher. So I don't know if I'm necessarily going to, count this one in the column for those that want to see lower rates quite yet. As long as we're sitting here right on that moving average, there's always the chance we can get a bounce from there. In fact, that's exactly what has happened in previous months. So until we start spending more time below that moving average, I'm gonna exercise caution as around how I'm thinking about that topic here at the moment. And remember, the opposite is also true. So while you might be getting more excited for bonds here, knowing that they were up a little bit on the month of August and that we've had a big push higher in government bonds over the past week and a half, notice where they're standing right now or sitting. They're right there on the underside of the falling moving average. So long-term bond prices are at a point of resistance. Long-term bond yields are at a point of support. They could easily both bounce next week, meaning that yields bounce higher, bond prices bounce lower. I hope that's not the case, right? I would prefer it not to happen, but I'm just being realistic with how I look at this, and that would not be a shocking development whatsoever. I think what's helping the case of bonds, generally speaking, is that once you move from the U.S. government bonds and start looking at the foreign bonds and the high yield bonds, there you have a little bit more of an aggressive push. Notice that we are well above the rising moving averages on both of those bond categories now. Notice that the moving average color turned green on both of those today. So that's a more promising sign, broadly speaking, in fixed income. But of course, what most of us keep our eye on are the U.S. government bonds, and they seem to kind of control the sentiment around the fixed income market for the most part. So let's see what happens next week. Can we get a push up and through the moving average on long-term U.S. Treasuries? If so, hey, we're in business. On the other hand, I don't want to, have it break my heart by expecting that to happen, especially when I can see with my own eyes it's sitting right at a resistance area. So, word to the wise there on that one. But hey, we'll take what we can get. We do have bullish postures across the board on the bonds, so credit where credit's due. On the lower left-hand corner now, we'll take a look here at the U.S. dollar. Dollar bounced up pretty nicely today. Remember, we were talking on Tuesday that this was a crazy candle right there. Gap up and then close at the low of the day. And that really allowed a big push higher in things like gold and oil and even the foreign stock markets. Well, fast forward here 2 days later, things are a little bit muddier there, not tremendously so, but today the dollar did bounce back. It was up pretty nicely, up 0.5%. So of course, no surprise that gold was down on a day like that. More surprising is that oil didn't care. And we've seen a little bit more of that behavior. I think oil is not necessarily as hitched to the dollar as it might be in other eras. I think right now oil has other geopolitical things going on, especially with, Russia, Ukraine, and all that kind of stuff. So it's not just like an anti-dollar story at the moment, whereas, with gold, there's not a whole lot else really driving price activity. There's not a whole lot of headline news or anything like that. So that might describe the differences there. But anyway, oil still looks really strong, right? Of those two charts, gold and oil, oil is the one that is trending here at the moment and strongly bullish. Gold is just weakly bullish, and its moving average is still going lower. Oil's moving average has been basically going up since the beginning of July. So there's more persistent strength taking place right there. You'll notice that the foreign stocks did struggle today as well. Notice that both of those categories were down worse than the U.S. That makes sense on a day when the U.S. dollar was up. So EFA, the developed foreign stocks, were down 0.39%, and then EEM was down 1.24%. I didn't really like the price action out of those two either, for the same reason that I was mentioning previously with those resistance areas I was talking about with long-term U.S. Treasuries. So notice how EFA and EEM both approached or touched the underside of that falling 30-day moving average. It's kind of similar to the Dow Jones as well. And they both rejected it, and price action pushed it down and away from those falling moving averages. That's not the type of behavior you want to see. You want to see it slash straight through them and do it with an emphatic move. Right now there's hesitation that is taking place there, and it's giving sellers an excuse to step in once again. So didn't really like what I saw out of them. Now, having said that, they do remain with weekly bullish postures at the moment, but I don't think that's going to last very long if we get another day or two of selling there. So, I'm not holding my breath on that one at the moment. Preferred stocks did quite well today. They were up 0.74%, and they did get up and through their falling 30-day moving average. So at least we can see an example of that can happen. We haven't seen a lot of charts where it did happen, but here's a good example of it happening on kind of a smaller asset class like preferred stocks that don't get talked about a whole lot. But they had a very nice day, so credit where credit's due there. And then Bitcoin had a terrible day. I actually didn't notice this until now. It's obviously not an area I pay a lot of attention to personally, but I didn't hear anybody talking about it today either. I was busy with a multi-hour class and doing some other things, but so I'm sure some of you were more tuned into that than I was. But wow, Bitcoin down 4% today and giving back basically that entire move from Tuesday. Remember, we were talking about how it had that huge gap up on Tuesday on that news that that Grayscale had won in the courtroom versus the SEC. Well, here we are 2 days later, and they just gave back all those gains on Bitcoin. So that is kind of odd and probably not a very good sign, all else being equal. It didn't even get above its moving average to begin with, and then gives back the entire move on what should have been really good news there. So let's keep our eye on that, but that's probably not something that you want to see if you're hoping that Bitcoin goes higher in the short term. It does have strongly bearish posture here with that deeper shade of pink in its background color. Let's now take a look here at our sectors. And this is chart 5C for those of you that are following along at home. And as you can see, we've got mostly green charts on the board, so we're happy to see that. However, we do have a batch of pink charts on the bottom rung. Remember, you've got your growth sectors up at the top, you've got your cyclical sectors in the middle rung, and then you've got your defensive sectors on the bottom rung. And those defensive areas, including healthcare, staples, and utilities, now have those strongly bearish postures. It's not a surprise to me with utilities and staples. We've already known that they've kind of been in the house of pain, so they're just kind of rubbing salt in the wound at this point. But with healthcare, it is a little bit more surprising because remember, healthcare had tried to firm up here in the last couple of weeks and was actually above its moving average for a decent chunk of that time. Notice the difference with healthcare in the lower left versus staples and utilities, which haven't even sniffed their 30-day moving average for about a month at this point. In fact, it's been exactly a month since the last time the utilities were touching its moving average. So it's been a really terrible month for utilities, a pretty darn bad month for staples. But for healthcare, it's been okay. It was really today that did them in. That was an ugly day for healthcare. Down over 1%, so 1.19%. Again, remember what we were looking at on the heat map. United Healthcare was down 3%. That's the most important company in XLV. I should say second most important. I almost forgot. Eli Lilly is now the most important. But nonetheless, United Healthcare is still incredibly important. And on a day when it was one of the worst performers in the market, it's going to have a bigger impact on its market cap weighted sector as well. So I'm pretty sure it's the managed care area that really struggled there within XLV today. So those areas are on the outs. All three of them, by the way, also trading below their falling 30-day moving averages. Healthcare's just came in today with that big down move. It bent the moving average from going up yesterday to going down today. Remember, that doesn't happen all that much either. Like, notice what happened here with staples. You went from green to yellow to red. You typically have that transition. This was a hard pivot on healthcare. You went green, red immediately on that moving average right there. I know it's kind of hard to see, especially if you're on a phone right now, but if I maximize this, you can see it a little bit better. That moving average was green yesterday. It's red today. There was no transition of yellow in between that, and that can only happen when you have a really aggressive candle like we saw right there today. So, that was an important one, and right now it doesn't look all that well for healthcare. So we'll see what next week brings and tomorrow too. But that's not a good looking chart there all of a sudden. At least with utilities, you could say that it's so bad it could be good, right? With healthcare, you're like, ooh, that doesn't look so hot, and you're kind of hanging up here near the higher levels of the month, meaning that there's plenty of room to go down. With utilities, because they've been in the house of pain for so long, you actually have another oversold cluster signal showing up here on utilities. And remember, utilities usually are a little bit more correlated to long-term treasuries. Long-term treasuries have stabilized, but utilities, they attempted to earlier this week, but that was a pretty lousy attempt if you ask me. And they're right back to that oversold cluster again. So are we due for a bounce in utilities? Yeah, we most certainly are. Will we get it? Hard to say. Anybody's guess. But things have rarely been worse for utility shareholders in the last decade or two. This is amongst the worst you will ever see the utilities trading on a relative basis versus the rest of the market. In terms of that final chart on the bottom rung, real estate, it did manage to squeak by with a weekly bullish posture, but still, I'm not particularly impressed with the chart. Take a look at that price behavior. It's similar to the Dow and a couple of those others like the foreign stock markets and some of those with that you had your reversion to the mean move. You went up and you kissed that downward trending 30-day moving average, and then it rejected it and pushed it lower. So we closed near the low of the session today, and you have that that red candle that's popping up there right where you don't want it to pop up. So I'm not holding my breath on REITs at this point either. In terms of the other areas, there we have more promise. And of course, the good news is the other areas are more important to the overall S&P 500. Most of these defensive areas down below are very small in comparison, so they don't have as big of an impact. But we want to see technology doing well. We want to see communications doing well, and we want to see discretionary doing well. And all three of them have had a very, very nice weeks. In fact, we're going to try to have a clean sweep in all of those areas if they can close higher tomorrow for the week, right? All of the days this week, those three sectors have been up on a market cap weighted basis thanks to the Magnificent Seven. So that's a good sign. It's helping provide stability to the overall S&P 500. In that middle rung right there, those are where we've got our more cyclical areas of the market. Those are kind of a bit more hit and miss. I'm not really sold either way on those. I think the jury is still out. The financials pulled back here today. They're kind of getting rejected at that falling 30-day moving average. Industrials is kind of giving us that same look at the moment. Remember, industrials has kind of been like the secret superstar of this market over the recent months. So finally, there's a little wear and tear taking place in the industrials. And really the same thing you could be said for the materials, although the materials are a pretty small sector, so it doesn't have a huge impact on the overall market. Industrial is much more important. But that leaves energy, and energy continues to look really good. It's an area we've been focusing on for the last 3 weeks in my top-down trend trading class for obvious reasons. This is one that continues to trade above its rising 30-day moving average. You can't even make that claim for the big growth sectors up above. They're back above it now, but they weren't a couple of weeks ago. Whereas in this most recent pullback, energy never did close below its upward trending 30-day moving average. So it's kind of our stalwart here at the moment. Remember when I was looking at the sector selector with you guys on Tuesday, energy was number one, and I think it deserves to be. This is the market cap weighted version of it, but even if you were to look at the equal weighted version of energy, it is also quite strong here at the moment. So that's where we have our persistent strength. Of course, that starts opening up the door for inflationary concerns as well, so careful with what you wish for there. But at least there are some areas of the market that are holding up better than others. All right, let's get into our trade application example now. And remember, I do these trade application examples while the stock market is still open. That way I can send out the trade details to all of you who are premium members of Market Scholars on our private Telegram channel. And remember, if you're not a premium member of Market Scholars, you're going to have an opportunity to do so at a discount as we get a little bit closer to Black Friday here. So keep that in the back of your mind if that's something that has been of interest to you in the past. But I'm going to guess that our premium members here today were maybe a little bit surprised when they saw what my trade application was. So let me explain. It's ticker symbol SBUX. Most of you are aware that is Starbucks. And we've been talking about Starbucks in some of my long-term investing classes here more recently. We talked about it a bit in my Tuesday dividend growth investing class, mostly due to the frustration that late last week it was actually trading at a level that we would have found it acceptable enough to consider it for a long-term portfolio. But by the time we got into that dividend growth investing class on Tuesday morning, it had surged away from us. So this was Tuesday's candle. But last week we were way down here below 94, and then in the blink of an eye we were up here at 99. So that was a huge push there. We also talked about this one in my options for long-term investors class on Monday afternoon as a put selling idea there. So a couple of our longer term classes, this is actually kind of within the range of getting interesting once again for long-term money. But what I did today was the opposite of that in this particular free presentation here, where we talk about shorter term trades, not long-term investments. And what I ended up doing here was a short selling idea on Starbucks. You can see after having this tremendous move from 94 up to 99, in fact it came up here and basically touched 100 here yesterday at its highs, you can see it gave back all of yesterday's gains and almost gave back all of the prior day's gains, which was the really impressive day there on Tuesday. Not a great look. Now some of this did happen in the final half of an hour. That was kind of the nice thing about this trade here today. We're already up a little bit on the trade because it did slip into the close, and that's kind of the other nice benefit there of receiving that information before everybody else does, because remember, if we had some sort of a sell-off into tomorrow morning's open, then people who are watching the free video are not going to get the same prices that we were able to on this trade. And so it doesn't always work out that way. I've told you guys in the past, there's been plenty of other times where, I kind of wish I would have waited until 1 minute before the market closed because it moved against me in the final half an hour. But today, it worked out to our advantage there that we short sold this and then it continued to sink into the close. And so doing reasonably well with it right out of the gate. So we'll see if that negative momentum that came into Starbucks today can continue in the short term. Remember, this would be just a short-term trade. Think of it as a swing trade where we do not anticipate being in this one very long. You can kind of see where our levels are set here with this upper line right here that I'm circling being where our stop loss is a little bit above 100, and then down below here this other horizontal line would be where we want the stock to go to lock in our profits. So typically when I'm doing these swing trades on individual stocks, I'm doing a 1-for-1 reward risk ratio. So hopefully the idea there is we'll have a lot of kind of 50-50 opportunities there, and the hope is that our win rate is slightly better than 50% based upon the way that we're reading the charts. But I always like to remind people, we will lose plenty of these trades. It's just the nature of when you do one-for-one reward risks. There's going to be approximately half of them that you lose and approximately half of them that you're going to win. But the hope is that you're slightly more into the winning category here. So you can kind of see why I might have been approaching this in the short term from a bearish perspective. We had this reversion to the mean move. It came right up to that downward trending 30-day moving average, nearly kissed it yesterday, and then rolled over, looking like it's rejecting that moving average here at the moment. In doing so, you'll notice that the background color of the chart went from this light blue to this light pink, telling us that this blue line on the market forecast, the near-term line, which is what I use for my swing trading class, is now in the bearish territory as it fell out of that upper reversal zone. You also have a little bit of a divergence signal here. Now, I don't want to make too much of this because divergence signals usually should have more than just one day in between of them, but you do have a high here on the blue line, a slightly lower high the next day, and you had a slightly higher high in price action. So improvement in price, but a deterioration in the underlying indicator. Sometimes that's a heads up that there's more than meets the eye than price, and you do have some of the indicators telling us that there's a little bit of wear and tear there that we'll want to be aware of. You can also see that Starbucks has underperformed the S&P 500 over the last 3 months of this chart, and most of the labels, the performance labels up at the top of the chart, are red, not green, telling us that this one has been weak in multiple time periods. Remember, a lot of those kind of Chinese related stocks have been struggling lately, including Nike and Disney and now Starbucks here, and that could play into what I'd mentioned before on the heat maps, where China has really struggled from an stock market perspective, and that's kind of carrying over to some of the US companies that do a lot of business in China as well. And of course, Starbucks is definitely in that category. Okay, so that's what I had for you here today. A simple swing trading idea on the short selling side of the equation on Starbucks. If you enjoyed tonight's presentation, if you got any value out of it, I ask one simple request out of you. Take 5 seconds out of your day. Click like for us there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'll be more than happy to give you another 1 hour long video. On the other hand, if you're kind of falling out of favor of clicking like and or you don't want these longer presentations, then don't click like. And if we're under 100 likes, then we'll keep it nice and short and simple and sweet for you there on Tuesday. But since this is the last time I will hear from you guys, or you will hear from me more or less before the holiday weekend, I hope you all have an enjoyable Labor Day 3-day weekend, and I'll look forward to seeing you all next Tuesday in one form or fashion. Until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.